Good morning, everyone, and welcome to the Experian Quarterly Business Credit Review for Q3 2019. I'm Gary Stockton, and before I introduce our speakers, I'd like to remind you to take the opportunity to engage our experts today using the question-answer box in your WebEx toolbar. We'll try to answer your questions following today's presentation. If you'd like to download the slides for today's program, the link appears in the lower right of all slides. We'll include the details in a follow-up email as well. During today's webinar, we'll be discussing key findings in the just-released Experian Moody's Analytics Main Street Report for Q3 2019. Our speakers today will be Christian Doridis from Moody's Analytics, Derek G. McCrank, also from Moody's Analytics, and Brody Oldham from Experian. Brody Oldham has 18 years of experience in disciplines including analytics, database development, and prospecting. He leads a team of statistical consultants while remaining an active strategic statistical consultant for commercial data sciences within Experian. In his current role, Brody provides the marketing and sales organizations with customized analytical support. And prior to joining Experian, he worked at Citi Cards and Citi Mortgage as the consumer credit risk analytical consultant. As an associate economist at Moody's Analytics, Derek G. McCrank is a member of the Credit Analytics Group in Westchester, Pennsylvania. Derek works on building stress testing models of consumer loan performance for a number of consulting projects. He has a bachelor's degree in economics from the University of Wisconsin-Whitewater. Chris Doridis is the Deputy Chief Economist at Moody's Analytics. In addition to developing econometric models and economic forecasts, his main areas of focus include consumer credit research, housing economics, and public policy analysis. Chris holds a PhD in economics from Johns Hopkins University and is a certified business economist. And now I would like to turn things over to Mr. Christian Doridis from Moody's Analytics.
Wonderful. Well, thank you very much, and thank you everyone for joining us once again for our quarterly Main Street Outlook. As is our tradition now, I will be starting us off with a macroeconomic outlook, providing a bit of a backdrop before we dig into some of the trends that we're seeing in terms of small business credit. Because this is the end of the year, the last presentation of the year, I will be, of course, focusing a bit more in terms of our forecast for 2020, what we see as challenges, where we see opportunities, what to expect in terms of economic performance overall. And that will then feed into, again, some of the consumer or the small business credit trends that Derek will be talking about. All right, well, let's get right to it then. And as you can see in my first slide here, if we look at GDP growth overall, so total economic output, what we can see is that the economy does continue to perform. And every expectation, under at least our baseline expectation, is that it will continue to perform in 2020. That is, the odds of a recession in 2020 are relatively low at this point, certainly lower than what they were either last quarter or the quarter before that when we met for our Main Street report. Growth in 2019, when all is said and done, should come in at about a 2 to 2.2% growth rate over the start of the year. So that's a very acceptable type of growth rate. It's positive. It's moving in the right direction. However, it is slower than what we had in 2018. 2018, you'll recall, we had a growth rate of around 2.93% on a year-over-year basis. However, we should view that as more of an anomaly than the trend that we've experienced during this expansion. And of course, you'll recall in 2018 we did have the tax cuts that went through, so pretty substantial amount of fiscal stimulus that did its job in terms of priming the pump and getting accelerating the economic growth. But then, as with every round of tax cuts or that type of fiscal stimulus, there is going to be some payback, and the slowdown in 2019 was expected relative to 2018. Nonetheless, again, a 2.2% growth rate is in line with the trend growth that we've experienced during this expansion, and it's also close to what we would consider potential growth for the economy, or the rate of growth where the economy is humming along with few signs of inflationary pressure. Unemployment is relatively low levels, right? That would be consistent with that potential, and we're right about there based on the latest data. As I mentioned, we should expect 2020 to be quite similar. Certainly In the first half of 2020, we should expect to see similar trends to what we're seeing today. The short-term data does not indicate any type of real change from the current trajectory. However, as you see in the chart here, I'm showing you a forecast, or the baseline forecast given by the red dotted line, or at least the perhaps magenta. It's the red dotted line that's right in the middle of the forecast. That's the baseline. You can see that for the second half of 2020, we do expect to see some deceleration in growth, right? Still positive, so it's still growing, but just not growing as fast as the first half. And that's really a function of uncertainty, or the continuing effect of uncertainty taking its toll on the economy. So uncertainty from trade and the trade war, potential escalation continuing, as well as some uncertainty now as we get closer to election. And the expectation is that businesses will be taking a back seat, waiting to see what happens in terms of election results before they commit additional capital or really go wild with any type of expansion plans. Now, the other thing to note on the chart here is that there are certain upside and downside risks. Those are identified by the green dotted and other red dotted lines that you see here. So you can see that there is certainly a range of possibilities for the economy to take, and I'll be talking briefly about some of those risks, particularly to the downside, things we want to keep an eye on. The last point to make, if you look at the bars in the chart, they represent the different components of GDP, or economic output, and what you can see pretty clearly is that all growth, nearly all growth at the moment, is coming from consumers. So we really need to pay attention to consumers, health of consumers, consumer attitudes, and finances to get a sense of how they're going to be continuing to spend or not, and that will have a very direct effect in terms of the economic activity next year. Right? Businesses are on the sidelines given all the uncertainty that's out there, and government also we're not seeing any sign that government would get together anytime soon to provide some additional stimulus to the economy and keep things moving ahead. So we do need to focus on consumers. The good news is, as we look at the consumer market, we see some very encouraging signs, particularly as we look at their consumer balance sheets. We see that incomes are up, wealth is also growing, and debt, or household debt levels, are relatively stable, or debt ratios, I should say, are relatively stable. So the consumer credit and consumer finance picture looks quite strong. The job market continues to deliver, and that's what you see illustrated on the chart here. Unemployment rate continues to track down to a 50-year low, or near 50-year low at 3.5%. We are adding jobs to the economy. The labor market report that came out last week was stellar, really adding jobs across the board in a variety of industries. And we're also able to continue to pull people back into the labor market who maybe had stepped out or had given up hope of ever finding a job again after the Great Recession. So we're making some real positive gains here in terms of providing opportunity. And you can see on the right-hand panel of the slide that the labor force participation rate for prime age individuals in the U.S., those individuals between the ages of 25 and 54, the labor force participation rate is now back up to where it was when we went into the Great Recession. So we've made a lot of progress on the labor market front, and that progress is translating into stronger confidence in terms of consumers, and that's really motivating or allowing them to spend more and to support the economic growth activity that we see. Another key encouraging sign when it comes to labor market is just the fact that we have a near record level of job openings, about 7 million job openings in the economy. As you can see from the purple line here, that's close to the highest level since the start of the data back in 2000. It has weakened over the last 6 to 12 months, right? So we have seen some decline in terms of that slack or those job market opportunities, but nonetheless, still quite substantial at 7 million. The other key takeaway from the slide here is that the quit rate, or the number of people who actually are quitting their jobs every month, continues to trend higher. That's a very confident sign, right? These are voluntary quits, so very positive indication that consumers are feeling strong enough, are feeling more positive enough in this economy and the labor market to go ahead and quit their existing job and take on a new job that will offer better benefits, salary, and better opportunities in terms of matching their interest and their skills. All of those factors should move us in the direction of improving efficiency, right? We want individuals to be not only satisfied with the work that they have, but also applying their skills in the best possible way. So those efficiency gains should translate into some higher productivity growth later on. At least that's certainly the hope. So labor market overall, as I mentioned, really showing positive signs. Hard to find any true signs of weakness. Perhaps if you're looking at retail trade or some pockets of weakness, you can certainly find them. But overall, the labor market should continue to support consumer confidence and consumer spending. On that note, though, that while the national picture may look quite solid, we do see some signs of regional weakness. And in the map here, you're looking at the Moody's Analytics business confidence or business cycle status indicators, right? So we take all 400 plus metropolitan areas and we will rank them on the basis of a variety of economic indicators such as employment, industrial production, housing starts, and home prices. Based on those metrics, we then classify the different metropolitan areas into different stages of economic expansion or contraction. The good news is at the moment, most of the metropolitan areas are in either mid to late stage expansion, right? So we are continuing to move ahead with the longest expansion in U.S. history and seeing a positive sign that that expansion is fairly widespread. It's not just expansion on the coasts, but we're seeing expansion throughout much of the country. I guess the dark lining to that cloud, however, is that we have seen some deterioration in economic growth in some areas. Actually, the number of metros that we now classify as being in recession or at risk has risen over the last year. There are about 5 metros that we classify as being in recession. They're mostly energy related, so areas of Louisiana, North Dakota, Alaska, West Virginia. There are some metros there that have crossed our threshold of being in recession. They are very much dependent on energy, and that's the rationale for why these areas have fallen into recession. They're not well-diversified economies. Nonetheless, you do see a number of metropolitan areas in the Midwest, in particular, that are teetering on recession due to some of the weakness in manufacturing as a result of the trade war. So that's certainly something to keep an eye on. If you have a portfolio with certain regional concentrations, you definitely want to take into account the different regional trends that we see here. So although the U.S. economy as a whole may be in relatively good shape, there are certain areas doing better and worse than others. If we want to get a signal of where things might be headed in 2020, given the high dependence on consumers at the moment, we need to take a look at consumer confidence. And that's the series that you're seeing, or that you're looking at on the next slide here. Consumer confidence, given by the purple line with the left-hand scale, is now still quite high, quite elevated, near the highs that we had back in the late 1990s, right? So that, again, is very much a direct reflection of the labor market. As long as we continue to deliver in terms of job growth, job opportunities, and some wage growth, you're going to see that households and consumers are going to express a fairly high confidence number, right? If you're able to get a job and continue to see some opportunity, that's going to really support your views in terms of the economy overall. There has been a little bit of weakness over the last year, again, as we saw with some of the other data, as some of the uncertainty around trade war, global economic uncertainty has filtered in. Most recently, we've seen a little bit of a turnaround, so things seem to be stabilizing, and consumers are not perhaps as pessimistic as they were just a few months ago. We've seen some positive signs like the labor market report last week. Nonetheless, it is a trend we want to pay attention to. It's not signaling anything major at the moment, but if we saw confidence starting to plunge rapidly, that would certainly be a telltale sign. If confidence falls, we'll see consumers pull back on their spending. And again, given how dependent the economy is at the moment on households, that could easily push us or pull us down into recession. So you do want to keep an eye on consumer confidence and some of the trends that we're seeing here. We are seeing that although consumers are spending, as you can see by the green line with the right-hand scale, that's the year-over-year change in real spending. They are spending, and the spending growth is a solid 3% that you can see here. It's not as robust or as strong as we might otherwise expect given the level of confidence. So consumers, although they're seeing that the labor market is producing, there is confidence out there, they're also still a little bit cautious, and you do see savings rates rising. Spending is there, but it's not as accelerated as we might otherwise expect. So clearly something to follow, that there is some of that uncertainty out there. And that uncertainty is really driven by any number of different risks that we have in the economy right now. And this is impacting both households and businesses, and in particular small businesses, which we'll get to in a second here. I have a threat matrix chart that we regularly update and examine in order to identify key economic risks and classify them both in terms of their likelihood of occurrence, that's what you see on the y-axis, as well as the severity of a particular shock, that's what you see on the x-axis. So at the moment, for example, if you go to the northeast corner of the chart, you can see that the escalation in the trade war remains one of our highest risks in terms of both probability of some potential escalation over the next 12 months, as well as a severity if we did escalate further, right? So that's clearly something that we're monitoring. As I mentioned, trade war has already taken a toll in terms of some business confidence and uncertainty that's out there, so has held us back perhaps in terms of investment, and that's why we want to pay close attention to this particular factor. Further escalation might start to hit consumer confidence more directly, and that, as I mentioned earlier, is a significant risk to the outlook at this point. Some other things we might want to look at are leveraged loans, so that's business lending to firms that are highly levered, right? There has been an explosion in that market, so that's a potential risk that we identify. And then there are other things like a Fed policy error, right? We hike rates too quickly or not quickly enough. That could certainly lead to recession, or Brexit continues to be in the mix in terms of potential risks out there. And then impeachment and the current impeachment proceedings. While the articles of impeachment themselves may not have much of an economic severity of shock, we do assign a fairly high probability that there will be a vote in the next couple of days here. Removal, however, as you can see in the lower left-hand corner of the president, would be a very low risk and likely low probability type event in terms of the macro economy overall. So these are the types of risks that we're tracking. In terms of the next recession, though, we are following a number of different indicators, and based on current imbalances in the economy, we would identify the next recession as really having more exposure to non-financial corporates or business lending overall versus stemming from household indebtedness. You can see debt ratios for each of these three different components: government, non-financial corporates, and households in the chart here. And you can see that household debt to GDP has actually been falling over time. It's really the non-financial corporates that have been rising, and in particular in that business lending, it is leveraged lending that we're most concerned about, right? We've seen an explosion in that type of lending as investors have been chasing some yield out there and trying to increase their returns. Finally, before we move on, I just wanted to end on a table here in terms of the key economic indicators we watch in terms of recession risks. So every day, new data comes out. We update our economy.com website with that data. And we also have done some analysis to identify which economic indicators tend to be more leading or more lagging. So trying to get a sense of what information we can glean from all the data that comes out. At the moment, as you can see by the risk column here, most economic indicators, most fundamentals remain in the green. That is, we continue to have growth, labor market is strong, there are a lot of things to celebrate or be positive about. There are a few items that are more concerning, such as slowdown in the manufacturing sector, right? That's clearly something we're watching closely. Although manufacturing isn't a very large part of the U.S. economy today, much more of a service-based economy, still there are potential spillover effects from manufacturing, so we do want to keep an eye on that. There are some other financial market indicators that earlier in the year signaled higher recession risk, like the yield curve, but those things have calmed down, so they're on our moderate list, but not something we want to get overly excited about. So yeah, I'll end there just by saying 2020 should be a slower growth year, but still a positive growth year. There are certainly risks out there, and if one or two of them should hit, that could certainly change the picture. But as we look at the world today in terms of the consumer and household credit picture, things look pretty good. And with that, I will stop and turn it over to Derek to take this and dig a little bit deeper now into the small business credit trends and what these macro level trends might imply for small business credit going forward. Derek?
All right. Thank you, Chris. Moving right into what's happening with small business. In the third quarter, small business delinquencies reached their lowest level on record, or at least in the history of our data set. And they fell below 1.6%, which pretty nice, pretty low delinquency rate there. And although we're seeing strength across a broad swath of the industries that we cover, we aren't seeing strength exclusively in the data. So there are industries that are not performing as well, such as construction, and we'll talk a little bit more about that later in the presentation. So moving on, the bankruptcy rate for the third quarter was also pretty low, coming in about 1.6%, which is down a little bit. So for those of you who read the report, you'll know that in the third quarter, bankruptcy counts were actually almost unchanged from the second quarter. So those businesses that were in bankruptcy in the second quarter, they've either exited bankruptcy or left bankruptcy at nearly the same pace as those businesses entering bankruptcy for the quarter. So that, combined with new establishments and businesses that are accessing credit for the first time, helps to actually push the bankruptcy rate down quite nicely, reversing the, I believe it was 3 quarters of increases that we had seen in the bankruptcy rates. Another part of why delinquencies are low and the bankruptcy rate is low are SBA loans. So for any of you who don't know, the SBA is the Small Business Administration, and they guarantee or back certain loans to small businesses. And in the third quarter, new gross approvals for SBA loans reached their highest level on record at $9.8 billion, which is up roughly 16.5% year over year, while simultaneously charge-offs in the SBA portfolio were at their second lowest level ever recorded. And I believe that was about $170 million worth of charge-offs in the third quarter. So again, we're seeing strong growth in small business portfolios for the SBA, as we're seeing within the Experian data, and which helps to validate the data that we have and give us assurances that what we're seeing in our own data is actually reflected in the broader pool of small business lending activity, which is always reassuring. Another metric that we like to look at for insight into what's happening in the small business credit realm is the Senior Loan Officer report put out by the Federal Reserve. So this is loan officers reporting on demand for C&I lending. And they break out by small and large and medium firms how they're seeing lending change. And although we're seeing seeing higher reported demand for C&I lending to large and medium firms in the third quarter, we didn't necessarily see that translate into more demand from small firms. So this is a little at odds with what we're seeing in our own data, but as well as what we're seeing in the actual hard reported data from the SBA. So since this is a survey-based metric, we aren't too worried about that, especially considering that much of small business lending is moving to online realms or fintech lenders. We are seeing traditional banks begin to compete with that. So, for example, it was just reported the other day that Wells Fargo is opening a new platform to revive its SBA lending, which, as of last fiscal year, was down quite substantially from even 2 years ago. I believe it had reached, it had fallen under $800 million or so dollars, whereas 2 years ago it was almost $2 billion. So we are seeing traditional banks try to start up their online small business lending platforms to compete with those new fintech entrants. So as we see banks move into that space, more small business lending activity can again be captured by the Senior Loan Officer Survey. So moving back into our own data, and specifically the construction industry, third quarter saw 31 to 90 or moderately severe delinquencies increasing primarily in the Plains states, so that region of the country, as well as other areas of the western U.S., whereas the southeast saw considerably lower, the southeast and northeast saw considerably lower delinquency rates among construction firms. And it seems that a lot of this could be tied back to commodity prices, trade war effects. So although we've reported in the past that, the trade war doesn't exactly impact small businesses directly because they aren't necessarily supplying international customers, it can have knock-on effects if the prices of a small business's goods are impacted. So most recently, I think we've all heard about, corn and soybean prices, which have been impacted by the trade war and reduced demand from China. Well, if I'm running an agriculture business in the Plains states or out west, and my prices have been down every year for almost half a decade now, do I need to build that new grain silo? Well, maybe I can go without it another year. So we aren't necessarily seeing that construction activity in the agricultural centers of the country, which can impact or have knock-on effects on other industries, in this case, construction, which is what we think is going on here, or seems to at least be part of the story that we're seeing play out. So last quarter, I kind of introduced everyone to the upcoming index that we're going to be releasing. In the last quarter, we've worked to expand the overall performance index and get indices for every industry. So this quarter, I thought that I would give you all a little teaser of the construction index that we've put together. So as you can see, for the last 6 or so quarters, the construction industry has really been having a tough time, and we are seeing that's turning around just a little bit now, especially for the 31 to 60 and 61 to 90-day delinquencies. But the 91 plus bucket is still showing signs of weakness. So as you can see, the 91 plus bucket is the blue bar on this chart, and it's been increasing for the last 3 quarters pretty steadily. We're looking for that to sort of plateau next quarter and maybe even fall a little bit, which is why you see the uptick in the index, or the black line on this chart. What's really good for construction and the lenders who are servicing small construction businesses is that although we have seen that delinquencies have been pulling down the performance of our credit index, as is plain as day on this chart, bankruptcies among small construction firms, which are shown in purple here, haven't been as affected, even though we are seeing that the 91 plus delinquency bucket has been increasing pretty consistently for almost a year now. We haven't yet seen that translate to bankruptcies, which is good for obviously the portfolios of the lenders servicing these businesses, as well as the construction industry at large. So I did mention the example about trade wars and how, commodity prices have been impacting construction, but there is another side to this. So our internal data at Moody's has shown that the value of construction put in place for residential home investment has been down on a year-over-year basis for at least the last year, and is only in the last month or so turned positive. And part of that is because, it's been a year and now we have a lower base to move from, so we're seeing some positive growth in those construction numbers. So construction put in place is up about 0.5%. I believe it was in October. So in the fourth quarter, we could see, if the trends in the value of construction remain constant for that residential investment, we could see some of these delinquencies in the construction industry start to reverse and bring up our the performance of our indices even more than they have been the last couple of quarters. So I normally do this at the beginning, but it slipped my mind. So I just want to thank our partners at Experian for the wonderful data that they provide, and say that I think the value that their data set holds, combined with the analytics that we at Moody's Analytics do, can really unlock some good value here in the small business space or small business lending space. Our data set is constantly, or Experian's data set is constantly growing. We're looking at about 8 million small businesses in a quarter now, which, as far as I know, is the largest data set for small business credit out there. So we get a really, really solid data set, and it gives us wonderful insight into small business credit and the trends evolving in that space. And with that, I will turn it over to Brody from Experian, and he will give an even deeper dive into the granular small business data.
Hey, great. Thanks, Derek. Some of these last trends that you were talking about here with the construction industry, our small business lending community has really been listening intently, and we see it in some of the conferences that we go to really address some of their customers' challenges and addressing some of those gaps that you're talking about that are helping to pull up some of those bankruptcy numbers. We're going to talk about some of that today, and I'll say the same thing to you, Derek and Chris, that we really enjoy bringing these macro views together, and I will tell you, I learn a little bit every time. I also want to thank Rick Tran and Antonio Mora for helping me pull these trends together today as well. So we're going to dig in, gain a little deeper perspective here on some of the forces that are driving our small business ecosystem success that both Chris and Derek talked about a bit. We continue to see some of the slowing in commercial investment into the U.S. small business market really since the summer, but I know we've seen some of that a little bit before. But I'm encouraged by our clients really preparing and pricing products appropriate for risk and creating some of those products that continue to grow in a leaner economic cycle, because that's what we've seen through the past probably year and a half, is it getting lean, a little fat, a little lean, and leaning out a bit here, looking for additional productivity. So we can certainly see some of the results of those initiatives and development of playbooks really to be more nimble when we get into more of a significant market shift that is really more negative. So we'll be looking for that certainly over the next few quarters. Now I'm freezing here. You can hear my voice probably shaking a little bit. I'm here in Texas. It's about 52 degrees, pretty chilly. We're going to take the next 20 minutes or so to get warmed up here with a fresh look at some small business lending in a little more detail. And the small business owner is where I always like to start, looking at their health, how they're performing. It really gives us a good short-term outlook, plays a great role in predicting the performance of their businesses, and we look at that guarantor's credit availability compared to the business. And this is really especially true when we're talking about small businesses, those that are new to the market. And we see a high percentage of these small business owners using their personal credit to fund their businesses. It's something that I did to start my small business, and for consumers really like me, home value played a big part in getting financing earlier. So home prices in the U.S. continue to trend upward. Consumer mortgage loan originations for banks and credit unions have really been accelerating. They're up about 84% in the third quarter. And as rates get some real relief here and refinance options are a little bit more attractive, this acceleration is really creating some good equity opportunities for small business owners. So HELOCs and HELoans have always required some better credit quality. And I'm going to give a call out, a shout out to credit unions for their ability to really price appropriately for risk and continue to support really the equity loan market here. They're reporting 5.6% increase year over year in production. Pretty fantastic on the consumer side. So just continuing with some of the consumer view here, when we look at HELOCs, so credit unions are performing pretty well in getting those out there. Some of the things that we're seeing on the consumer side, though, or in especially the HELOC space, is that to get a HELOC, about a year ago, it took a Vantage score of around 709. That's a pretty good score, not fantastic, but pretty good. And this year in the third quarter, it's gone up to about 728, so a pretty significant change there on the consumer side. So they're tightening a bit on the consumer aspect and consumer criteria that goes into some of these originations. Now, some of the same products that are available that add credit for these guarantors and in our consumer space, we see that consumer credit card originations, again, up 9% year over year in personal loans, and we heard Derek talk a little bit about some of that fintech lending that's out there. That, again, is up 17%, so good increase, good strong performance on the consumer side year over year. And they're continuing that upward trend. The utilization rates are remaining pretty stable and steady, but we're seeing some lenders begin to tighten their criteria, as I talked about a little bit with the HELOCs and HELoans, even though it's much more tempered with just a few points here and there from the previous quarter. So these consumer products help small business owners find funding when commercial sources are really not available. When we see a tightening on the consumer credit, which I've talked about a little bit here, we look at how commercial lending facilities really will fill that gap. Now, we're going to dig into a few commercial credit trends to highlight some of the specific behaviors that we're monitoring. To do that, we utilize a more granular set of data that's made up of small businesses with tens of millions of payments a month across a wide array of industries and products, and that's what you're seeing here, the small business credit share data. Now, it's a focused consortium data set. It includes expanded payment performance data on products like lines of credit, credit cards, loans, leases. It's just a great way to look for signals that are predictive of future origination, payment, even delinquency as you go through. And these trends really play a role in signaling a pullback or trouble in a specific industry, which we did see a little bit in the last quarter across the commercial products. And the lender criteria being used to originate. But those trends that pulled back in the previous have really changed a little bit here, and we're in growth mode in this quarter to close out the year pretty strong. And we're going to point out a few of those very specifically in the next 20 minutes or so. So we're going to kick it off right now with installment loan performance. The commercial installment loan origination chart that you see here highlights the percentage of loans out of the portfolio loans that are held here at Experian that were originated within the quarter. And the installment loans that you see have a high dollar value, fixed terms, payments. They take a little more time for a small business to acquire than applying for some type of unsecured product with a lower line usually, like a business credit card. But what you're going to notice on this slide is the drop in origination volume in the first quarter of 2019. Now this is a seasonal trend, and it's similar to the origination performance of previous years. What you'll notice is that in the second quarter, and our expectation again is for the third quarter, will and have outperformed previous quarters. So when we look beyond the account volumes to the account average balances for installment accounts, you really are going to look for those that have lower risk, better credit quality segments. The balances in these type of installment loans have really increased year over year, and the average of those increases about 40%, so pretty good increases year over year in balance, average balance. And the highest risk segment that we saw, so that's really your low credit quality folks that are out there trying to get these types of loans. We saw about a 5% decrease in the average balance there. So this highlights a bit of the strategy change that is really in the volume of dollars being lent on the risk tiers. And we're going to dig into that thought just a little bit deeper in the next few slides. So you can see the change here on the far right. Installment originations have been picking up some steam, and the loans being originated now are a little more risky than in prior quarters. And when we look at the quality of installment loans originated as a predictor of long-term performance, this strategy is originating accounts at a higher risk level with a lower available balance, and the push is really to the less risky paper is really to look for more high balance type of products. And it kind of makes sense. You're lowering your balances on the high risk and you're increasing those on the low risk. So the risk segments are defined by our Nutella score, and your eyes are probably drawn to the red, the high risk, and the yellow, the medium high risk bands. We're seeing an increase in origination where we had been seeing a reduction in the previous quarter. And this really falls in line with the tightening of the consumer paper. Also falls in line with the education push to small business owners to utilize commercial products, which we've highlighted the need for this type of education and promotion in almost every lending presentation that we've given this year. So it's important as it really helps to increase the business owner's consumer and commercial scores by increasing their commercial trades, so what they have on our book, and then decreasing their credit utilization on their personal accounts. It's going to bring up both scores, so it really helps out our small business owners on both sides of their credit. So the other thing is commercial lenders have been lending a little deeper to fill in some of this funding gap that we've seen. And the changes over the last 24 months that we're seeing here are really showing the trend toward underwriting a little bit more risky paper. You're going to see that at the arrow just above. So when we break out these portfolio trends really into risk segments and industry and look at the same quarter in the prior year, we see that the portfolio views are pretty stable. An average balance for each of the industry is noted here by the dot. You're going to see it with the balance amount right next to it. We see some changes in balance risk in mining, just as Derek mentioned before. As businesses have seen some of that global pressure and the changing in the landscape of the market, we continue to see tariff activity impacting this industry for at least the next year. Oil prices have stayed fairly stable between $50 and $60 a barrel, and that allows for some additional planning and execution of the strategies within these types of companies. And this is really helping the segment to clean up a bit. Now, we continue to monitor segments like agriculture due to that continued uncertainty that they see with their trade constraints. You know, we had a pretty wet planting season over the summer, and so that's really focused in the Midwest. But the recent execution and the agreement that we've seen with the USMCA this week by our North American partners here should create some relief, and we're looking to really at some of the other industries here with some of the same lens. Now, we continue to see that same positive trend in these industries as well. We see that installment lending portfolio risk is being underwritten and held in portfolios, and it's pretty stable at this point as far as the way that we're seeing it. Now, the next trend we look at is really in the overall commercial installment delinquency. We break the U.S. down into regions, and you'll see those on the right. We're really doing this to identify some areas of strength and potential weakness in the U.S. as it relates to a region's specific mix of industry and market drivers. And for the most part, delinquencies on installment loans are ticking upward in almost every region. With the Southwest, with its focus on energy that I know Chris talked about a little bit before in some of those MSAs, and the Midwest with its focus on agriculture and manufacturing, you're going to see some of that heightened increase in delinquency really exceeding some of the prior years. Again, we expect some relief to be felt within the system following the execution of the USMCA, and we see lenders are also lending a little deeper into these segments, just to those that are a little more credit hungry and credit needy. Now, the average balance by installment risk has been increasing for the overall installment portfolio. Low risk account balances have seen really the largest uptick here, and I'm highlighting some of that through the origination volumes. We're seeing that some of those have decreased in the low risk rating tier. The amounts borrowed are on the rise when you look across what's being borrowed here in the balance. We will match really the medium high risk segment for more significant increase over the next quarter, and that could be really a leading indicator for some of our larger businesses and small emerging businesses seeking some increased commercial funding and some cash flow. So we're hoping that's going to hold down some of those bankruptcy numbers that Derek mentioned a little bit earlier. So we talked a little bit about commercial delinquency here. We're looking at overall the trends are pretty stable. You'll see in the 30 to 89 days past due term bucket. The overall installment portfolio, you'll see for charge-offs, we don't look at individual quarterly trends. Instead, we look at longer trends to avoid the noise and policy adjustments. We do continue to see the charge-off rate dropping quarter over quarter. No delinquency trends here are particularly dramatic in the small business installment lending overall. But when we break these out into industry segments and regions, you're going to see some increase. Higher delinquency trends in areas impacted by regulatory and trade uncertainty. Now we're going to look a little bit next at commercial lines of credit. Now, from the first quarter, originations picked up a bit into the second quarter, but they were still down 24%. You're going to see that. In the third quarter, the trend is still expected to be pretty low, slow down year over year. Most regions are seeing that decline in this type of product, with the Southwest seeing only a slight increase. We're seeing that new originations by our small business lending community are seeing some seasonal slowdown trends compounded by the prior quarter slowdown, and they're trying to take some action here to try to catch up, and we may see that after the first of the year. But if we look at originations by risk tier, balances have pretty much dropped across all risk tiers. And our hypothesis is that small businesses are looking for longer-term funding options as rates get some release. And we've, as Derek talked about, some of the SBA loans with their 25-year terms. Now, we've had 10 and 20 before, but this is a little longer. It's going to keep those payments down, and it may be encouraging some of these businesses to look at those types of loans versus some of the lines of credit that are available. Now, when we are looking and thinking about seasonal trends and account originations, you're seeing some signs here of some loosening in the third quarter to address some of the slow originations. And what you'll see is that these top bands here are expanding a bit in the yellow and red. a little more risk than prior years, but we're not seeing anything very significant in 2018. Now, just like installment loans, when we break these portfolio trends by segment and industry and look at the same quarter in the prior year, what we see is that everything's pretty stable. Construction and mining still throwing things out a little bit, but again, the USMCA will most likely help some of these industry segments to improve. We're hoping to see some of that color come back after some of the uncertainty in the recent view of the market. Now, we see again in these industries that you'll see on the screen, again, we're seeing some signs of improvement. Now, we see delinquency levels remain very stable. In the Southwest region, I'll call out some significant increase in delinquency levels, trending upwards since about the fourth quarter. The Western region slowing a little bit, but the other regions about where they were about a year ago. Utilization has really remained stable, dropping slightly over the past 24 months. Commercial line of credit delinquency trends at a national level, we continue to see improvement and have remained pretty consistent over the last few quarters. We see some divergence in 0 to 60 days past due in the later stage delinquencies. That really means that accounts that are rolling past 60 days past due are more likely to go into severe default. Now, we'll look at further divergence in these data points in the future, really for some more significant trends there that could be real predictors of increased late-stage delinquency and potentially a lift in some of that charge-off activity. Now, let's talk quickly, just for a minute here on commercial credit card. You're going to see really some increase here. What we've seen is that originations continue to be on the rise for commercial credit cards. Origination risk distributions have loosened a little bit within commercial credit products, but that's really as the recession trend has been pushed out about a bit, and Chris talked about that a little bit, and some of the signs have been pushed off. Now, this commercial credit card product will be one of the first to see some machine learning improvements you'll see out there in the market. It's something that creates some stability and enhanced profitability views when you're using some of these techniques, and it'll should start to impact the market pretty soon. Now, when we break this down, what you'll notice when we break it into industries is that you're going to see, again, mining and construction and manufacturing become a little more risky than they were in prior years, but we're hoping that that continues to be a little bit more tempered as we cross into the new year. My expectations is that we'll see the same across industries using credit card into the fourth quarter as well. Now, delinquency rates remain low. You heard Derek say that. They're really low right now. Most of the regions that we're seeing are above or about the same as they were about a year ago. As we monitor the delinquency trends, we really should consider what's reached late stage, where collection activities are taking place and debts being written off. We see the percentage of accounts charging off has really stabilized over the past few quarters, but we expect this trend just to keep chugging along and continue where it is right now. Now, we do see some utilization increases in the medium, high, and high-risk segments of the portfolio. All over, we see that they're pretty stable. The slowdown in origination and lines of credit and these product types over the past quarter may lead to some increase in utilization in commercial credit cards. So looking pretty good so far. So where do we want to see an increase in utilization? Well, I'm going to tell you, and I think it's a gift. Merry Christmas, Happy Holidays. I include Black Friday and Cyber Monday in these. These are where my family bonding activities happen. It's an opportunity to sit in the cold and the rain to get a great deal. The retail industry has really been figuring out that it's fun for us to sit out there in the rain, but it's not joyous as part of this holiday season. So the retail market has really been adjusting their strategies, been watching this just at a micro level too here. Their strategies to address some of the consumer demand for more digital shopping experiences versus that foot traffic. Now, the NRF said that during this holiday season, in-store sales are going to rise about 2%, but e-commerce is really going to jump about 14%. I've seen numbers much larger than that. That's good for some of the large retailers, but for a small business, it's really hard for them to make that transition from small to a large online presence. So the commercial real estate space is really trying to claw back from a few slips earlier in the year. And we see the commercial origination slipping, and only the installment-type loan trades experience some increase in delinquency. So pretty good overall, slipping a little bit. We're right on the edge there, hoping that the holiday season will return just some good results. And the delinquency rates, you know, even though they're fairly stable, we're hoping that the USMCA, again, will be a big help in moving this in a positive direction in the new year. So 6 less days between Thanksgiving and Christmas this year. I hope you have your shopping wrapped up. Let's wrap this up real quick, too, here in our trends. So what should we take away from today? Overall outlook is positive. Business owners are looking pretty good. A little tightening on the consumer side. Commercial lending loosening up a bit to take up some of the slack in the tightening of the consumer credit market. We see some increased delinquencies. But I think we're in a pretty good position right now. We're looking for some help from the USMCA. You've heard me say that a couple times. So I think we're looking pretty good. So I hope this has been helpful. I'm going to turn it back over to our moderator, Mr. Stockton. You want to open it up for a question or two?
Yeah, there was one question that came in I think Christian was going to try and address there about unemployment.
Yeah, absolutely. So the question was, why is unemployment listed as a high risk in my table? If I go back to the table on slide 17 here, you can see the first line, unemployment rate. So a great point, because we did have this very favorable employment report just last Friday, and the unemployment rate is so low. So why would we suggest that it's a high risk? Well, the thing is that it's not, the metric in the table is not just the unemployment rate, it's the unemployment rate minus what we call NAIRU, a non-accelerating inflation rate, adjusted unemployment, or the natural rate of unemployment. What we've seen historically is that when the unemployment gets low, when it falls below a level we consider natural, that is, it reflects an economy that's kind of in the Goldilocks state, where there's no inflation building up. We've historically had a recession about three years later. By the latest estimates, this natural rate of unemployment is 4.5%, and we fell through that level back in 2017. So based on that metric alone, you would say that there's a high risk of unemployment going forward. There's another rule that's come out. It's called the SAM rule. It's SAHM. It's a rule that was put out by Claudia Sam of the Federal Reserve, where she identified a relationship between a 50 basis point jump in the unemployment rate above its low over the previous 12 months as having a very high correlation with a recession as well. The point is, if unemployment rate is so low, the chances are that it's going to go up from here, more downside risk than upside risk. And for that reason as well, you would consider the unemployment rate as being a high risk indicator for recession. However, last point to make is that you shouldn't consider any of these indicators in isolation, right? That the unemployment rate being low may be a red flag, but as long as everything else is still operating well, functioning in the economy, as we can see it is, then the recession risks remain relatively low. So it's something to keep on your radar, but it shouldn't dictate your decision.
Excellent. Thanks so much for clarifying that. Well, I'd like to thank everyone for attending today's session. Sorry we ran out a few minutes over there. Thank you to Derek and Christian from Moody's, and to Brody from our analytics team for sharing these insights. When you close the webinar, if you could please just answer a few brief questions. For more information on Moody's Analytics, of course, that's at moodysanalytics.com and then experian.com/B2B. And I'd like to wish everybody a very happiest of holidays. We will see you in 2020 for the wrap-up of Q4. And so have a good day, everybody. We'll talk to you in the new year.